Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on another due diligence assignment and couldn't make it today. So, of course, we have James Eng sitting in. And James, how are you?
Great. Thanks for having me, Paul.
No problem. So what's going on in the Old Capital world today, James?
A couple things. The main thing is our next big event will be on Thursday, September 13th at the AT&T Stadium. So we'll have 500, 600, 700 people there, really focusing on B&C multifamily at that event. So you'll meet the top listing brokers, property managers, lenders at that event. And then we'll wrap up with Roger Staubach talking about how he, had a ton of success on the football field, but then also translated that into his company of Staubach. So definitely go on to the Old Capital Podcast website and register on the right-hand side.
Also, I would want to also bring up to June 21st, we're going to be up in San Jose. So everybody, usually the investors come down from Northern California to Texas to kind of see what's going on out here. But again, we're reversing the roles. June 21st, we'll be up in San Jose at the Northern California meetup, sponsored by JC Castillo and Brad Summer up there. And June 21st, go to the oldcapitalpodcast.com website and register to get into that event. That's going to be a fun event. We're going to have 3 or 4 people that are going to be doing case studies of properties that they own here in Texas, but they actually live up in Northern California. So you want to be listening and be a participant about how they did it. So that's going to be very exciting. So June 21st, make sure you are able to attend that. So in the podcast today, we're going to do something that's a little bit different because we're going to talk to 2 gentlemen that have kind of gone full cycle on a couple different things. They have been into the multifamily, the business. They've been into the hotel motel business, and they are building apartments and senior living facilities. So we're going to talk a little bit from the ABCs of how to build apartments. So if you're ever thinking about at any period of time about building your own apartment, you want to have kind of an inside conversation with folks who actually have done it, not just theory, but these guys have actually done it. So in the podcast today, we have Vino and Mangesh Patel. Vino is the father, Mangesh is the son, very competent guys. And so Vino, welcome to the podcast. Thanks for coming in. We appreciate that.
Sure. Thank you very much. And we love to, talk to you guys.
Sounds good. Mangesh, thanks for coming in. And I'm going to kick it over to James.
Vino and Mangesh, thanks for coming in. I think really to start off, maybe give people a little bit of your background, sort of what you did maybe before real estate, and if you started and born and raised in real estate, maybe tell us how you got started. Let's start there.
Sure. My name is Vino Patel, and I was born in India, but I came to U.S. for higher education. So I started with SMU, and I graduated from UTA Arlington in 1975. With industrial engineering, as well as I had a business management as my minor. But from day one, I felt like real estate is the best place to invest. And so I went into real estate, buying a first hotel or motel in 1978. And then reason I bought motels is because at that time there was a lot of demand, and the cap rate was almost like 25. And, during that time, you could buy something for less than $5,000, $6,000 per door. And real estate, even if apartments, I didn't understand at that time. I understand now. But at that time, apartments were also selling around $5,000, $6,000 a door too. But motels for high cash flow compared to apartments at that time. So we bought motels. And, good part about that, we don't have to do any marketing. People come to us. And we don't have to, communicate too much except, just give them a clean, comfortable rooms. And I like that concept. And since that, we invested in several properties. And almost I had 25, 30 hotels, motels. And I started building some new construction in 1982. construction costs at that time was like $30-$40 a square foot. And my cap rate was like, on a new construction, built-in cap rate was like 25 to 30 cap rate. So we made pretty good cash flow from day one. So, I started doing multiple properties, new constructions, as well as we bought some existing hotels, like Holiday Inn and some of the franchise property. But I didn't like that much in a food operation. And then we got hit with some recession back in late 87, 88. And because of the saving and loans tobacco, and my debt was almost 13-14% interest rate. So we decided to lease some of the operation to mom and pop. And that really got me interested into looking into other alternative, which is apartments. And I think since 1998, we've been buying apartments, especially B and C class. And after that, the cap rate started going down and down. So we thought, hey, we can build some more new projects if we can build something at 7 or 8 cap and sell for 5 cap. So that's where we are now. We're developing new apartments as well as a new senior independent living.
And Mangesh, where do you fit in that whole story?
I'm a sibling of 3. I have an older sister, myself, and my younger brother. All 3 of us, we were born and raised here in Dallas. We all went to SMU, all received our BBA real estate finance degrees, then thought that one of us should become an attorney just because we used to spend a lot of money in legal bills. So fortunately or unfortunately, that responsibility came to me. So I went to law school at SMU as well. And then once we graduated, 3 of us, we have our own responsibilities. My sister handles all of our accounts, insurance aspects of the business. I handle finance, legal, new construction developments, buying and selling. And then my brother, who really doesn't like to stay too much in the office, he handles all of our management operations. So he's always out in the field.
So how was it, this is just from my perspective, I have 3 kids, and maybe talk about the dynamic between growing up in the business and seeing what your dad did and then now being in the business. We're very spiritual. We have a spiritual background, a family-oriented background. We never really were exposed to his business side while we were growing up. Because he made it a point to always come home at 4:30, 5 p.m. By that time, we're coming home from whatever, football practice, basketball practice, whatever it may be, and we're always home together. And, we had a rule, we'd always eat dinner together and talk about, our days, whatnot. And, that culture, family values was very important to us. So we really weren't exposed too much to it when we were growing up. But as we got older, it was just a natural thing that we all wanted to go down that field into the business operations. We're all kind of more, math oriented as opposed to, say, science oriented. So we weren't really, none of us really wanted to go into becoming a doctor or any kind of medical field. So it just became a natural fit. And I think due to us living together and always being around each other and liked being around each other, we all kind of wanted to stay together in the business operations as well. Okay. Vino, when you were raising the kids and then also growing your business, can you give us a little bit, did you take them out to any of these properties, or did you show them anything, or was it more when they graduated you just said this is the place for you, or what? Tell me about that, because I think that's unique in that it's sometimes difficult for a lot of people who are running a real estate business to transfer it on to the next generation.
Sure. First, most important thing for us is the family values as well as religious values. And so we go to a temple called BAPS temple, which is a Swaminarayan temple. And, they always teach us that staying together is more important than making a lot more money. If your family is with you, your health is well, then you always will be, in a good hands. So based on that principles, whenever we were growing, I had delegations. Delegated my authorities. I had a staff of 300 to 350 people working for me. So I always had a free time. During the development, and I'm talking in, when they were younger in 80s, I had a general manager, I had a controller in the office, then I had a staff of, legal assistant, administrative assistants, accounting people. All these guys were helping me, so I had more time to go look at more properties. So when I was growing up, if I was, looking at some land with my wife. I can take, my children's with me. They wouldn't know what we were going for, but at least we may stop by for using restrooms in one of our hotel. And they'll ask me, say, who are you? Because they wouldn't know me because I had 25, 30 properties. I hardly used to go to, because I spend more time in, developing side, finance, and keeping a full control on all the accounting and on the management side. But at the same token, I always devoted more time for the family. So I go home at 4:35.
So tell us a little bit about, you guys were in the hotel/motel business. What did you like about that, and what didn't you like about the hotel/motel business?
Number one, we like the cash flow aspect. So it always had a very good cash flow. By the same token, it required a lot of attention. So if I give you a comparison, that would be a fair answer. So say, for example, apartments, we have 200 units apartments versus 200 units hotel. So in a 200 units apartment, it takes 12 months for the 200 people to come in and check in and check out. In a 200 units hotel, you have 200 people check in every day and check out every day, next day. And that's too much turnover, too much management, and too much maintenance issues and keeping track on everything. So I think one of my son who is managing all these hotels, he tells me that give me 10 apartments versus having one hotel, because that's the least, apartment has the least amount of headache. It's an investment property. And that at the same token, when recession hits, if you have made a lot more money, but the recession hits and if your occupancy drops below 50, 60%, you could wind up losing the hotel. So compared to apartment has always 80, 85% occupancy, no matter what you do. I mean, there are 360 million people in America, and all these people have to go home and sleep somewhere. So either they have a home or they have apartments. So apartments are very, very safe. Of course, it gives you a little bit less return, but if you know how to do it on a B and C class, we discovered that we can make more money in apartments than hotels after 98, 2000.
Do you own any motels or hotels anymore now, or have you sold all of them?
So I sold most of them to, mom and pop, leased them. They operated, and then, because remember I told you that the interest rate was 13, 14% back in the old days. So, we had to kind of, liquidate whatever we can. I didn't want to have a big overhead of my managing 300, 400 people as employees with the $1.52 million was payroll at that time. So we basically sold out everything. The last property I sold a couple of years, 3 years ago, back in Comanche, near Glen Rose, Comanche Nuclear Power Plant. We were hoping they were going to build a new power plant, so we kept that property for a while. But apparently, government didn't go forward with that project. But
so on those properties, so hotels, motels, essentially you have a one-day lease or one-night lease, and then you're having to turn it over. How much more staff on those properties, let's say on 200 units, you might have, 6, 7 people at an apartment, but how much staff do you have at a motel like that for 200 units?
So typically hotel or motel with 200 units will require about 20, 25 staff.
Okay.
And if you have a restaurant, then you're looking at 40, 50 people working there. So compared to that, with apartments, you're looking at maximum 6, one manager, assistants, and couple maintenance, and, one, like
a leasing
assistant to maintenance for picking up the garbage and all that. So you're looking at 6, 7 people. So it's a much more less staff oriented as far as the apartments are concerned.
So Mangesh, tell us a little bit about the transition from motels, hotels into apartments. What year again was it that you guys started in that, and what type of criteria were you looking for?
We made that transition in around 2000, 2001, I believe we bought our first apartment complex, Walker Place Apartments. And I think the biggest transition was understanding how the cap rate functions and how adding value by increasing your income and reducing your expense, that net operating income, how that translates into a higher value of the asset through the cap rate. I think that was a big new point to think about, as opposed to in a hotel operation, you're operating at 13, 14, 15 cap rates. Even some places today operate like that. So you see that cash flow. Whereas an apartment complex, if you bought it at 7 or 8 cap, you're not seeing that same type of cash flow. but you're getting that capital gain return. So I think once we got into it and bought our first property and renovated it, fixed it up, that was kind of our model, buying B and C class assets built in the 70s, 80s. We go in, my brother would fix them up, spend, anywhere between $3,000 to $6,000 a door. And then we turn around and sell them with a whole period of, 3 to 5 years. And then, we found out that one, we were getting capital gain, which is from a tax perspective helps, as opposed to your cash on cash return on a hotel operation, which might be, more ordinary income as opposed to capital gain. So I think the net effect also helped us realize a faster multiplier on our equity, comparatively speaking, to a hotel motel operation.
So is it more difficult to just get, so let's say you bought a 200-unit motel in the 90s, even though you maybe raised the sort of daily rent that you were charging for one night in an apartment, you could sort of do that over time and then actually capture that gain by either selling it or refinancing it. On the motel, it was harder because you were probably constantly changing that daily rate, I'm assuming.
Right, that's correct. Yeah. And typically hotels, your daily rate doesn't change that frequently. You are more susceptible to market conditions, like in 06, 07, 08 time period, when we hit that down market, DFW hotel market, it crashed. Even if you're around the airport, which generated a lot of the business, you still had a tough time.
Nobody was traveling.
Exactly. Yeah. So you had a tough time even just paying your mortgage. Whereas if you had apartments at that time, like Vino said, your occupancy may have dropped from 93, 95%, maybe to 85% worst case scenario. But you're still able to service the debt and pay your expenses and still walk away with some cash flow with no downturn. So I think that's a big difference also that we haven't mentioned, that in hotel operations, you can have your downturns could be, negative 50% cash on cash. You may have some real good years, but, you may need to store up the money, right, for your downturn years. And good hotel operators do that. And, they're willing to go through bad cycles like that.
So if I may add, since we discovered apartment investments, we felt like this is a lot better compared to hotels. So let's forget the hotels for one minute, and I'll explain you the concept of apartments. So first of all, we always buy, if we do buy, even in today's market, we have to have at least 3% spread above our cost of borrowing. So if I'm borrowing at 5%, and if I have 3% spread, I have to have 8 cap. So I can buy anything right now. That's the reason we're building new product. But we'll talk about new products later on. But let's go back to 2000. So in year 2000, when we started buying apartments, our criteria was to buy at 10 cap. So if we find some deals at 10 cap, then what we do is, our goal in mind is how we can improve this 10 cap to 12 to 13 cap. So first of all, we buy a deal, solid deal at 10 cap, and then we'll reserve at least 10% of our capital for improvements. So on a B and C class, there is always room to improve. So once we add $5,000 to $10,000 per door, sometime maybe less, 2 things happens. Number one, the property looks good overall from outside, inside renovation, repaint, restripe, reparking lot, and then renovate kitchen and all interior, repaint inside, recarpet. By doing this, all the tenants who are staying there are very happy. So they bring their own family and friends. Hey, look, somebody is taking care of this property, come on over here. They wouldn't mind to pay us $50, $100 for higher rent. Without we asking, we'll be able to get higher rent. So by doing this, what happens when we bought the property at 10 cap, so I'll give you an example. If the property was worth $5 million and $500,000 is your net operating income, which we call NOI, now what happens is when we buy the property at $5 million and we drop in, say, $1 million, our cost base is $6 million, but it has improved the value of the property substantially, and here is the how. Because that 500,000 NOI becomes almost like 700,000 NOI by this way. First of all, if the rental income was, say, $1.5 million on this $5 million property, then my income goes up and my expenses goes down. Because when we drop in $1 million in a property, and by renovating and all that, our maintenance expense, our turnover expense, because families like to stay with us longer than 6 months, 12 months, they keep renewing it. We had a very similar example of Hillside Apartments we bought back in 2003. This was a almost 180, 200 units apartment. And same thing, we dropped in a lot of money. That property stayed almost 95% occupied. And my NOI went up, from 500,000 to 600 to 700,000. Now at 10 cap, the same property is going to be worth, I'm not going to sell at 10 cap, but if I sell it at 9 cap, then that property is worth $8 million. So now we had $5 million in capital costs, $1 million or less for improvement, and the property is worth within 1 year almost like $8.5 million. So we can cash out at $8.5 million, or we can continue to enjoy our cash flow at 12 cap. So my partners will receive almost like 20-30% return on their equity, because again, remember, we leverage, and also in our other concept, when we buy this property, say at $5 million, we're going to have $1 million for renovation and fix up. So our cost is $6 million. So we go to bank and borrow based on $6 million, not based on $5 million. So at $6 million, if we're borrowing 80%, I'm almost borrowing $4.8 million, close to my purchase price. And I have $1 million in my bank account, and the bank is very comfortable. And we drop in that $1 million, and we almost buy it for very little cash out of pocket, and we still have enough money to fix the property. So by doing so, we have accomplished two things. We have given in most of the equity partners, they would achieve almost 25-30% return on their money, and not only that, if we decide to sell, we have double or triple within less than 2 years from the original capital investment.
No, that's perfect. That's a great example of sort of adding value and sort of how looking at the rehab and then how that improves the value of a property. I want to go back to a point on when you're looking at the spread between your debt cost and your cap rate. How did you come up with 3%?
Well, normally we feel if we're going to make some cash flow and we want to have a safety. So I'll give you an example. We bought another property, Estrada Apartments, back in 2007 or 2008, when things were also going down. Again, we bought it for $5 million, and then we have to have this 3% spread between the cost of borrowing and that. Either we look at their current operation, which is their P&L, and we plug in our own numbers, then we know that our purchase price is going to be at X amount of dollars, and that's going to produce my actual cap rate for us. We do not know. We don't compare even their cap rate. They may be operating at, maybe at 5 cap because their expenses are higher. Sure. But in our case, when we plug in our expenses, our cap rate would look a lot better than their cap rate.
Okay. So even in 2008, you were able to get that big of a spread between your cap rate and the cost of debt. So if interest rate was 5%, you were still buying at 8% cap rate.
Yes, absolutely. Okay. Actually, even our criteria was to buy even at 8 or better cap rate too. Okay. Even today, I will give you an example of I bought a couple industrial buildings last year at almost 9.5, 10 cap rate. And the rates were like 4.5, 5%. But on industrial buildings, we always like to have 3 to 4% cap rate. So we wouldn't buy any Walgreens or anything at, like with very little spread, like less than 1% spread. The only reason is if the interest rate goes up or if we lose tenant, then that property becomes, worthless in that sense.
Now you buy these apartment buildings with other investors. Do you have a big group of investors that go in with you to buy these buildings?
So sure. Whenever we buy apartments, we always have our own equity, our family equity in place. When I sign a contract, with or without any equity partners, we're going to close the deal. So because we want to expand and have some more properties with our own expertise, we can give more return to our investors. So what we do is we try to buy, first we used to have 50%, almost 50% or more our own equity in the deal. And then we open up for our friends and family, and they will come in for rest of the 50% of the equity. So we always show them a pro forma, what it will do on a very conservative model. But so far, we have done better than what we say on the model.
So you have happy investors that have invested with you for a number of years. That's
I would
great.
call my spoil partners, because those guys got the return between 25, 30, 40, 50%. One example I'll give you, we had a 1030 exchange guy came in. He actually came to buy our property. He bought the property, and then, with some of our things, what he saw, and he felt we were very honest and a family-operated company. So he thought he would bring and leave us a couple $1 million in the next deal. Only condition he had is make sure that he doesn't want to pay tax. So he wanted to exchange. So he came in with $2 million, and he walked away with $11 million. So, almost 5 times more.
That's a good story. And economies of scale, too. This is a kind of a family-run business, and Mukesh, your brother, kind of runs the management side of the business, and there's great economies of scale when you can manage these apartments and manage it through kind of a family-run organization. So there's not a lot of levels of management overhead. Would you agree with that?
Yes, that's correct. Just because we can manage it from our office here, everything that we own is within 45 minutes radius. So my brother and my uncle, they usually visit these properties, every, at least 2 times a week. They have a good hands-on experience with the staff there. They have good control over the staff. Any kind of maintenance issues, we try to handle as much as we can in-house, as opposed to, a third-party management company. They may have more contract services type of operation, whereas we try to get our maintenance guys to do as much as we can in-house, saving that overhead cost and whatnot. We also save on payroll expense, since we can interview ourselves and find the right employees with the right benefits, compared to, say, bigger management companies that their vested interest is really only their management fee, whereas our interest in the deal is more to, once again, generate a higher net operating income by reducing the expenses. So I think that aspect of owner management operations significantly helps us to increase our NOI.
So you guys are not buying apartments of 30, 40-year-old properties. You guys are transitioning and have been transitioning for how long into building new apartments? So let's talk a little bit about that.
Yeah, so the last deal we bought was actually 2012. And thinking about it now, it's, we're looking at 6 years ago, which is hard to believe. Between 2001 and 2012, we probably went through about 20, 25 properties in buying and selling. And ever since then, we haven't bought too many deals. And I think the problem is that, we have this spread in mind, 3 to 4% spread between our rate and our cap rate. And we're just not able to obtain that due to the market conditions since 2012. So at that point, we decided, look, we have a development background. Vino built 30, 40 hotels back in the 80s. We did some one-off apartment deals. Our first deal was in 2008 in New Braunfels, which was a growing market, 152 units. Then we did another one near the lake in Granbury in 2009. So we said, look, we have this background. It's just a matter of going out there and finding land and trying to go with this development concept. So let's make that shift. And we decided to go ahead and do that in 2014, 15.
So when you're looking at, let's say, a piece of dirt and you're trying to put together a new construction plan for one of these properties, tell us sort of how those steps are different than if you're going to go buy a B or C property here in Irving.
The B and C class is pretty easy. You're looking at the offering memorandum and you plug in your expenses and you come up with your price. And then, you close within 60 days or 90 days, whatever it may be, with the lender. And it's just a matter of finding the lender and then you're putting your equity together. So it's pretty easy. Development is actually totally different. I think the hardest part is actually finding the land, finding the right land parcel for the amount of units that you want to do. Because a lot of the cities are opposed, I would say is a good word, to multifamily, just because it brings in more kids into their school system. So they always prefer single family homes versus multifamily. But there are some, leftover lands from bigger developers. So what we found a niche in the market that there's nobody really developing 120 to 250 units. The majority of the developers, multifamily developers out there, are building 300, 400 plus units. For them to make economies of scale, and they have to build at that range, where we can manage our own construction in some cases, at least manage our development costs, have a little bit less overhead, and therefore we can make 150, 200 units development projects actually work.
Okay, just to give people who haven't done development an idea, like let's say it's 200 units again, you're going to build that, like how much land do you need for that, and sort of what, you don't have to give the whole secret recipe, but maybe some of the key characteristics that you look for on a piece of dirt. So if there is something out there, what should people be looking for?
Sure. Yeah, I think the main thing is we like to develop in growth markets. And not only that, if it's a good existing market, as long as the rent per square foot supports the development, I think that's the key fact. And then, you have to do a market study when you're looking for the land, make sure you're in an area that can support the rents. So like to answer your question on a 200 unit project, that depends on the city as well. The city have their own restrictions on multifamily developments. Typically in Texas, most cities have a rule of thumb that's 18 units to the acre. Now, if you're going to do an urban style design, that's urban style I mean by a single building, more compact, what you kind of see in uptown, downtown areas. That you can probably do on smaller acreage sites, but once again, you're subject to getting that approval from the city. But the rule of thumb is typically 18 units to the acre. With urban style, you can go up to 30, 35 units to the acre. And once again, this is all 3 and 4 story wood construction, garden style construction. You can go into high rise, and that's a whole nother ballgame, which we have not entered.
So just to do sort of a rough back of the napkin, you got 20 acres, you're going to get 200 units. And then what's the construction cost today on a garden style and suburban DFW, like roughly?
If I had to guess, you're looking at about $110,000, $120,000 a door on a garden style development, which is your least costly of the multifamily development types. And to just rephrase, the 18 acres, if it's a 200 units, you're probably looking at 11 or 12 acre sites. So it's not 20 acres.
Sorry about that, yeah.
But yeah, I would say about 120,000 a door is probably a good range.
And so if a developer has to build it at that, they typically throw on at least like a 15-20% profit on top of that. What rents do you need to get to sort of pencil today on a new construction deal?
On a new construction garden style, I would say $140 a square foot is probably good and reasonable. Anything above that is great. But even getting to $140, it's pretty comparable. You're seeing 80s, 90s vintage properties getting $120 and $125 in that range in the markets that we've been looking at. So, getting $140 might not be that out of the ballpark in those specific areas because, if you got a brand new property with stainless steel appliances, new flooring, everything's new, residents would be willing to pay that.
Vino, so going back to your 3% rule, I like that. How do you do that on a deal that is a piece of dirt right now?
Sure. So first of all, what we do is, let me give you fundamentals so that way everybody can understand. If anybody wants to go into this business, they're welcome to do that. And we'll be happy to guide them and teach our own concept. But mainly, as Mangesh said, we look for the land, pocket land, which is left over by the big boys. And we have to make sure the market and the surroundings is at $1.30, $1.20. So at least when we bring a new product at $1.40, $1.50, and then we don't have to do a whole lot of things. If we build 180 to 220 units, and if there is surrounded by a lot of properties or a lot of apartments around them, we're going to fill up that place so fast because most of the properties are, at $1.30 with the old style, garden style, old beat up property. And when we give them a brand new property with granite countertop, LED lights with the separate, high efficient air conditioning units and their utility bills, they know, they're smart. It's going to be less than $50. And, when they move with us, they're going to get a free cable, free internet, a lot of other things we offer. And that's all included in our package. When we give at $1.50, we pick up that occupancy pretty fast. So my job is to find a pocket land, which is a leftover land, or it has some engineering challenges. And with my background of engineering, and we have a good consultant, civil engineer, and a good architect, Arrive architect. So those guys can come up with a really good optimum design for us. And as long as we can bring the construction cost down by negotiating with the general contractor and keeping their overhead and profit low as much as we can, I think we can deliver a good product and we can still maintain that spread. So as for example, if last project we built, our rates were like 4.5% on 188 units apartments, but at that time our construction cost was very low, but we were able to get into model that we will bring in at 7.5. So almost we still maintain that 3% spread between our borrowing cost versus what he's going to do. And actually it turned out to be at 188 units, and we expect almost $1.5 million NOI. So that will produce almost like 7.5 cap for us.
So that's on like a year 2 or year 3 pro forma number, your NOI.
Yes, sure.
That your cap rate is based on. Okay. And then, so how many new construction deals have you guys developed?
So we have done, several of these projects. We like to make sure that we manage. So right now we already got a couple projects done. So we have 2 under constructions, and then we are also developing a new one, which is the senior independent living. And we can talk about senior independent living. If anybody who wants to learn that concept, we will be happy to share that idea. But I'll give you an overview of my study. So in a demographic study, which shows that there are 65 million baby boomers are already entered 65 plus, and they're expecting another 25 to 30 million people will be moving into, in next 10, 20 years. So like by year 2035, we should have 100 million plus people in this category. So once they go above 65, 75, 85, they try to downsize their homes, and they move into the senior facility. So based on the study, what we're showing in Dallas-Fort Worth, I'll give you the example. There is a 30,000 units available, but we see a demand based on JLL, CBRE, and MDS research. They're showing almost 120,000 units in demand. And we'll never catch up on a senior independent living side. And of course, same thing true for assisted living too. Of course, assisted, they have 40,000 supply right now. So that may be a little bit less, demand. They have more supply for the assisted living. But overall, a lot of people like to build senior living, independent living with assisted living and a memory care. We like to keep ourselves only focus on the senior independent living, which is more close to hotel, with my hotel background, because we offer some food service catering, catered by outside third party, as well as with our interior corridor design, fully air conditioned. And also it's a, hybrid, more or less like apartments, and it provides different, facilities. So we're building some senior independent living facility now.
So Mangesh, I got a couple of questions I'd like to ask too. Is that I think what your value-added proposition is that you guys do pretty much everything under one roof. You kind of are the developers and say the contractors and oversee the property and manage the asset. As economies of scale, you can build a higher quality property at a lower cost than a lot of the big institutional builders of apartments. Is that right?
Yes, that's correct. To go back on that, let's take an example of the 200 units, garden style. That would probably cost us somewhere between 22 to 24 million to develop, which includes your land cost, your soft costs, your interest carrying costs, your working capital, and then of course your hard construction cost. And we can manage all of that to do that at 22 to 24 million. You take that same project and go to these big developers in town, and that same project would be up to 28 to 30 million. The project will actually appraise at 28 to 30 million. So for them, it makes sense to do that. It's just that they got an additional $4 to $8 million in fees, whether it's through developer fees or, financing fees, or just other additional cushions in their hard construction cost or whatever it may be, that their cost just ends up being higher. So for us, on the flip side, we build it for 22 to 24 million. We actually get that same appraised value at 30 million, and therefore our banks are happy as well, because now they're lending on 70% of 22 million, which is, let's call it 15, 16 million. So on appraisal value, loan to value basis, it's 50%. So they're very happy. We can get the project done for a lower cost. And at the same time, if we want to sell the project, but because we built it for a cheaper value, we get higher returns on the back end too.
I think the most difficult concept in new construction is really where to begin. So when you have an apartment building that was built 30 years ago, that's pretty easy to understand. So when you're buying, because you're just buying a completed project, 30 years ago, but in new construction, many investors just don't know where to begin. So my question really is, where do you begin when you want to build an apartment building?
Yeah, to begin, so we would have to once again start with the land. It takes some time to buy that land, actually to find that land. Once you find the land, you got to go through city process. By that I mean, you have to get P&Z approval, go to city council approval with your site plan. That in itself, just from a time, I'll give you some timing as well while we're explaining this. That could take 60 to 120 days just to get your site plan approved. Now, once you get your site plan approved, then you can release your architect and civil engineer to go ahead and go full steam with developing the plans. Now, that's another aspect to it where you have to balance, do you want to buy the land before you get the city approval? Typically, we don't like to do that. We would like to try to tie up that land for, say, 180 days under contract. So by within that 180 days, 6-month time period, we know that the city is going to approve this site plan that we like. Yes, we may not start on our actual architectural civil plans by then, but at least we know the city's okay with it, and we want to make sure that city council's okay with it. Now, in some cases, that process can go a little bit faster with the city, and you can start your plans. Now, that's the most optimal way of buying the land, is actually getting your city approval and getting your plans approval, getting your building permit, and then closing on your land. A lot of developers do try to do that. Once again, that depends on the factors of the seller of the land that you're buying the land from. See if he's willing to give you that 180 to 6 months to 9 months time period to go through that whole process. It's a grueling process, and at the same time, it's expensive. I mean, you have to put in $50,000. Just I would say is a good number to kind of get your plans you need to submit to the site plan, and then pay for your application fees and whatnot. And then once you decide to go full-fledged with the plans, the architect and civil plans, that could cost you additional up to $400,000 to $500,000. So you could be all in at $500,000-$600,000 plus the land cost before you even break ground. So you have to make sure you have that equity in place to do that. And then at that point, the next step typically is to, once you close on the land and you have, depending on where you're at in the building permit stage, typically 60 days, 90 days before building permits issued, we would like to go and get our bank financing. There are some developers that will even make sure they get the bank financing even before they close on the land, so they know they have something to go forward with. We have several banks that we're connected with that have given us kind of like an open line credit. They know that we do this on a repetitive basis and can provide that type of loan financing on new construction. Because once again, with us, they understand that in reality they might be at 70% of our cost, but really they're at 50% of appraised value. So they're very comfortable in allowing us to do repetitive business with us. So we don't have that risk. The other developers may have that risk of placing that financing after closing.
Did you do an FHA loan in the past, and would you recommend that for somebody?
Yes, we have done an FHA. So our first apartment development we started in 2008. We built 152 units in New Braunfels, Texas, which is kind of right in between Austin and San Antonio. It's on the outskirts of San Antonio. And San Antonio's growth was always growing north, and Austin's growth was growing south. So we thought that was a good location. We initiated to go forward with an FHA loan on that project. The program's actually called the 221D4 loan program. It's actually a great program for new construction. They give you a 42-year term, which includes a 2-year interest-only construction time period plus a 40-year term thereafter. Now, when I say 42 years, means that there's no call in 5 or 7 or 10 years like Fannie Mae or Freddie Mac do. they will actually let you have that loan in place for 42 years at a very good rate. Right now, that rate is 3.8 to 4%. And the other plus side is it's a non-recourse loan. Even the construction aspect of it, which is typically unheard of. If you go to conventional banks, you're getting recourse loans.
Tell me the bad side of that.
Now, the bad side, we've done one deal, and it's good and bad. But the bad side of that is that that deal took us 17 months to place the loan. We always tell the story that it takes 17 months to place that loan, 12 months to build it, and then 7 months to fill it up. So as long as it took me to place that loan, we built the property and filled it up in the subsequent 17 months. It's a tough process. HUD makes you sign a lot of documents from a legal standpoint. It's pretty grueling, and they just have a lot of different reviews in between. And it's just it's a government loan, so it takes time as any other typical government loan that would.
So when you guys are looking at these properties, I mean, especially on maybe the financing side, but then also whether you go FHA or you go for recourse bank loan, when you guys are developing, a lot of people are a little bit scared of developing into a cycle, say at the top of a cycle, and then the bottom falling out. And so on the BNC stuff, we feel okay because, the market goes down, rents come down a little bit, but your occupancy is still 80 to 85. So how do you get comfortable, or what's the exit plan on a lot of these developments when you don't know what's going to happen in the next 18 to 24 months?
Yeah, I think the key factor is upfront, you have to know your market very well. You have to know it well enough to forecast what you think your worst case scenario will be in 2 years. Like right now, we're in a pretty up and down cycle in the stock market, bond market. Overall economies, I think everyone would say it's pretty good. But, I think we all kind of know that we might be peaking at some point. So to actually forecast 2 years out, it's kind of difficult. But from our perspective, we look at, we are predominantly the DFW Metroplex. We have a high influx of population coming in. We see that as a high demand generator. We see that being very safe. We like to go into, existing areas that are solid areas or growth areas, like here, Frisco and Allen, McKinney, those are heavily populated growth areas with a lot of corporations coming in. So we'll do that research up front and make sure we're very comfortable with that area from a market study standpoint. And then number two, of course, make sure that we're comfortable with the rent per square foot that we think we can get. And then, of course, there's risk. There's risk in anything that you do. But, I think we minimize that risk by building 150 to 200 units where you could potentially put that up anywhere. And if you don't have too many new properties around you, the existing tenants will always automatically filter into your property.
Yeah, the Patel's platform or model is a little bit different from everybody else's. Is in that value-added piece that at least I see, we've done a number of transactions together. On the banking side, for going vertical on these properties, is that they're providing a product at probably nicer than the institutional builders are doing it, but at a much lower price point. And so if the market does get soft, you guys are not in it at $28 million. You're in it at $22 million in that deal.
Right, and that helps us sustain that. If worst case, if there's a downturn or, if you're looking from a conservative approach, because we're at a lower cost basis from an exit strategy point, once we get this property up and running, if we think whatever the market conditions are, it's good, and as we are right now, then we could exit and get to take our capital gains and put it in another deal. And if not, then we know because we built it at a lower basis that we'll be able to sustain any downturn and hold on to the property.
So how many apartments have you guys done new construction, and then how many have you held and how many have you sold?
So we have built 6-7 properties right so far. That's including the 2 that are coming out of the ground right now. That would be 750 units or so. Out of that, predominantly the first 4 we've sold, and we sold within a 5-year hold period. These deals that we're building going forward, the senior independent living deals are, our exit strategy is probably to hang on to them. And just from what Vino explained, that the market is in high demand, so we think that it would be a good cash flow operations. Senior independent livings typically give you a higher rent per square foot than a multifamily project would, but the cost would be very equal. There's a very less spread in the development cost of building a senior independent living facility compared to a multifamily.
If somebody wanted to know a little bit more about what you guys do, what's the best way for them to get in contact with you?
I think the best way to get in contact with us would be you can either call myself or Vino or email us as well. My email address is mpatel, M-P-A-T-E-L, at mphpartners.com or Vino at mphpartners.com. So I think that's probably the best way. If you need to reach us by phone, you can call Vino at 972-756-0249.
Boy, I could sit here all day, James, and just shoot questions to these two guys. Any other questions, James, before we end it?
No, I think that's great. I mean, I think you guys have really shown that, like Wayne Gretzky sort of skating to where the puck is going to be and try to be early on some of these things instead of late. So great. Thank you guys for coming in.
So thanks for showing us a little bit around the ABCs of apartment developing, and we appreciate that. So Mangesh Patel, thank you. Vino Patel, we appreciate that. James Zhang, thanks for hanging out. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.